Think about this for a second. You're driving down the road, maybe a little late for work, and suddenly, bam, someone cuts you off. Your heart races, right? That little knot of anxiety tightens in your stomach. Now, what if I told you there's an entire industry built on that exact feeling, on that little bit of what if? That industry, my friends, is insurance. We all have it, right? Car insurance, home insurance, maybe even that extra gadget insurance nobody really understands. And on the surface, it makes total sense. You pay a little bit now to avoid a big financial hit later. Seems logical, right? Well, today, we're going to pull back the curtain and see that it's not always as straightforward as it seems. We're diving into the fascinating and sometimes a little sneaky world of the psychology of insurance, selling you peace of mind at a premium price. Now, here at The Rational Wallet, we're all about understanding why we do the weird things we do with our money. And insurance? Oh boy, insurance is a goldmine of weird financial behavior. Because it turns out buying insurance isn't just about crunching numbers and calculating risk. Nope, it's deeply tangled up in how our brains work, our fears, our hopes, all that good, messy human stuff. And that's where our favorite playground comes in, behavioral economics. Think of behavioral economics as the study of our financial brain bugs. Those little quirks and biases that lead us to make decisions that aren't always, well, rational. And trust me, when it comes to insurance, there are plenty of these little critters running around in our heads. So, what are some of the big psychological principles that insurance companies cleverly, and sometimes not so cleverly, tap into? Let's break it down. First up, we've got something called loss aversion. Now, this is a big one. We have a dedicated video on this topic if you need deeper understanding, but let me simply put it here. We humans feel the pain of losing something way more intensely than the joy of gaining something of equal value. It's like finding a $20 bill makes you feel good, but losing a $20 bill makes you feel really bad, right? Insurance companies know this. They frame potential future events, a car accident, a leaky roof, as losses that you can avoid by paying their premium. That small monthly payment suddenly feels less painful than the potential catastrophe. It's like they're saying, hey, you could lose everything, or you could just give us this little bit of money and poof, problem solved. Our brains are wired to jump at that chance to avoid pain, even if the actual risk of that big loss is pretty small. Makes sense, right? Next up, we've got something called the availability heuristic. Sounds fancy, but it's actually pretty simple. We tend to overestimate the likelihood of things that are easily recalled or that we've seen recently. Think about it. If you just saw a news report about a massive hurricane wiping out a town, you might suddenly feel a much stronger urge to get flood insurance, even if you live miles inland on a hill. The vividness of that image, the emotional impact of that story, makes the event feel more probable in our own lives. Insurance companies often know this and might subtly play on these kinds of readily available memories, even if statistically the chance of that specific event happening to you is tiny. It's like when you watch a shark documentary and suddenly think every dip in the ocean is teeming with great whites. Probably not the case, right? All right, moving on. Let's talk about framing. Now, how something is presented to us can have a huge impact on our decisions. Imagine this. An insurance policy is described as having a 99% chance of protecting your family's financial future. Sounds pretty good, right? But what if it was framed as having a 1% chance that your family will face financial hardship despite having this policy? It's the exact same thing, but the first way of framing it feels much more appealing, doesn't it? Insurance companies are masters at this. They highlight the positive, the peace of mind, the security, and downplay the negative, the cost of the premium, the limitations of the policy. It's all about how they paint the picture for you. And finally, let's touch on something called the status quo bias. This is our natural tendency to just stick with what we already have, even if there might be better options out there. Think about how many of us just automatically renew our insurance policies year after year without really shopping around. It just feels easier, doesn't it? The thought of researching different policies, comparing coverage, potentially switching companies, it all feels like a bit of a hassle. Insurance companies love this
because it means many people will just stay with their current plan even if they could get better coverage for a lower price elsewhere. It's the financial equivalent of staying in your comfy old pajamas even though you know you should probably put on actual clothes. Now, knowing all this, you might be thinking, okay, so insurance is just one big psychological trick then? Well, not exactly. It's important to remember that insurance does serve a very real and important purpose. It's there to protect us from those truly devastating, high-impact events that could bankrupt us or leave us in serious financial trouble. The issue isn't with the concept of insurance itself, it's about understanding why we buy the specific insurance we do and whether those decisions are driven by a rational assessment of risk or by these psychological nudges that we've been talking about. Because let's be honest, sometimes we end up over-insuring things that have a very low probability of happening or that wouldn't actually be that financially damaging. We pay a premium for that extra, maybe unnecessary layer of peace of mind. And while that peace of mind has value, we need to ask ourselves, are we paying a premium price for something that's not really giving us much tangible benefit? So, how do we cut through the psychological fog and make smarter, more rational insurance decisions? Here are a few things to keep in mind. First, understand your actual risks. Take some time to really think about the likelihood of different events happening in your life and what the potential financial impact would be. Don't just rely on those scary news headlines. Look at the statistics, consider your own circumstances. Second, compare policies and prices. Don't just go with the first quote you get or the brand you see advertised everywhere. Shop around. There can be significant differences in coverage and premiums between different insurance providers. It might take a little effort, but it can save you a lot of money in the long run. Third, and this is crucial, read the fine print. I know, it's boring, but you need to understand exactly what your policy covers and what it doesn't. Don't just rely on the sales pitch. Those exclusions can be really important. Fourth, challenge your emotional responses. When you feel that urge to buy more insurance because of fear or anxiety, take a step back and ask yourself, is this a rational decision based on risk, or am I just reacting to that feeling of unease? Sometimes, just being aware of these psychological biases is the first step to overcoming them. And finally, consider self-insuring for smaller, more manageable risks. Instead of paying a premium for something that has a very low probability of happening and wouldn't be that financially damaging, consider putting that money into a savings account instead. You become your own insurance company for those smaller bumps in the road. So, there you have it. Insurance isn't just about numbers. It's a fascinating dance between probabilities and our own psychology. By understanding the tricks our brains can play on us, and by being aware of how insurance companies sometimes tap into those tendencies, we can all make smarter, more rational decisions about protecting our financial well-being. What are your experiences with the psychology of insurance? Have you ever felt pressured to buy more coverage than you needed? Share your thoughts and stories down in the comments below. I always love hearing from you. And if you found this video insightful, be sure to hit that like button and subscribe to The Rational Wallet for more explorations into the fascinating world of behavioral economics and your money. Thanks for tuning in, and I'll catch you in the next one.